Welcome to Lukebook, Money and Wealth Building, explained for Singapore, not borrowed from somewhere else. In this episode, a clear-eyed look at Singapore's three local banks, DBS, OCBC and UOB, as long-term investments, and the one trap that catches the most investors. DBS, OCBC, UOB. If you own shares in Singapore, the odds are overwhelming that you own at least one of these three, and quite possibly a great deal of one. They are the default core of almost every local dividend portfolio, the stocks your uncle swears by, the ones that just keep paying. But should they be? In this episode, we put Singapore's three banks under the microscope, as long-term investments. The dividends, the fortress balance sheets, the real risks, and the one trap that catches more Singaporean investors than any other. This is not a buy or sell recommendation. It's the full, honest picture, so you can decide for yourself. First, why do these three loom so large? Because Singapore's banking market is, essentially, a three-horse race. DBS, OCBC and UOB dominate local lending and deposits in a way few banks anywhere enjoy. The regulator even designates them domestically systemically important, which is a polite way of saying they are too important to fail. That dominance, that stability, and decades of reliable dividends are exactly why generations of Singaporeans have treated bank shares as a kind of national savings account with a yield. To understand them as investments, you first have to understand just how solid, and how similar, the three of them really are. But they are not identical triplets. Each has its own character. DBS is the giant, the largest bank in Southeast Asia, the most digital, the most regional, and as of May 2026, trading around $59 a share near record highs. OCBC is the insurance bank, owning Great Eastern and leaning into Greater China and Hong Kong, at around $23, it too sits at an all-time high, worth over $100 billion. And UOB is the Southeast Asian specialist, the consumer banking champion across the region, recently swallowing Citi's regional consumer business. It trades around $37. Three banks, one country, three quite different bets. Let's start with why so many people love them, the bull case. Because make no mistake, as businesses, these are genuinely world-class. There are real, durable reasons they sit at the heart of so many portfolios, and it's worth understanding each one before we turn to the risks. Start with safety, because it is extraordinary. All three Singapore banks carry credit ratings among the very highest in the entire world, the second highest tier any bank can hold, shared by fewer than 25 banks on the planet. Their core capital ratios sit around 15%, making them some of the best capitalized banks anywhere, fortresses, built to survive storms that would topple lesser institutions. When you buy these shares, you are not gambling on a fragile business. You are buying a slice of three of the safest large banks in existence, backed implicitly by one of the world's few remaining AAA-rated governments. For a long-term investor, that durability is worth a great deal. Next, the real reason most people own them, the dividends. This is the heart of the investment case. As of May 2026, DBS offered a headline forward yield of around 5.5%, UOB around 4.6%, and OCBC about 4.3%. On $100,000 invested, that's $4,000 to $5,000 a year in income, landing in your account, for simply holding the shares. And historically, these dividends haven't just been paid, they've grown, year after year, through good times and bad. For an income investor in a low-interest rate world, a rising 4 to 5% yield from a fortress balance sheet is a powerful thing. But here is where I have to be straight with you, because this catches almost everyone. That headline DBS yield of 5.5%? It is not quite what it seems. DBS is currently paying a special, temporary top-up called a capital return dividend, an extra 15 cents a quarter, on top of its ordinary 66 cents. That bonus inflates the headline yield, but it is only scheduled to run through 2027, and then it is expected to roll off. Strip it out, and DBS's true, sustainable, ordinary yield is closer to 4.7%, right in line with its peers. This is the single most important thing to understand about bank dividends today. Always ask whether the yield you're being shown is the real, repeatable one, or a temporary sugar high. And there's a final, quietly beautiful part of the case, one we touched on in episode 1. In Singapore, the dividends these banks pay you are completely tax-free in your hands. Singapore runs what's called a one-tier system. The company pays its tax, and what reaches you, the shareholder, arrives untouched. No dividend tax, no extra layer. So that 4 to 5% isn't a pre-tax number that shrinks on the way to you, it's yours, in full. Combine genuine safety, a real rising yield, and zero tax on that income, and you can see exactly why these three stocks have anchored Singaporean wealth for half a century. So that's the romance. Now let's look under the hood at the actual numbers, because 2025 and 2026 have not been an easy stretch for the banks, and an honest investor needs to understand why. Let's begin with profit. These are staggeringly profitable companies. In 2025, DBS earned just over $11 billion. OCBC, around $7.4 billion. UOB, about $4.7 billion. To put that in perspective, DBS alone makes more money in a single year than most listed Singapore companies are worth in total. But, and this matters, for the first time in years, all three saw profits dip in 2025. DBS slipped 3%, OCBC 2%, and UOB fell sharply, down more than 20%, after setting aside money to cover risky property loans in Hong Kong and China. After years of record-breaking results, the banks have hit a genuine headwind. And it has a name. That headwind is falling interest rates. Here's the mechanism, simply. A bank's core business is to borrow money cheaply from your deposits and lend it out at a higher rate. The gap between the two is called the net interest margin, and it is the engine of bank profits. When interest rates fall, as they did sharply through 2025, that margin gets squeezed, the bank earns less on every dollar it lends. Across the sector, this margin compressed meaningfully in 2025, and is expected to keep narrowing, more gently, through 2026. That is the entire reason these record profit machines suddenly went into reverse. The good news for investors, by early 2026, with rates stabilizing, many analysts believed the worst of the squeeze was already behind them. But here's what cushioned the blow, and it's a genuine bright spot in the bull case. While their lending margins were shrinking, the banks were quietly building a second engine, wealth management. As Asia's rich increasingly park their money in safe, stable Singapore, the banks earn fat fees managing it, fees that have almost nothing to do with interest rates. In early 2026, even as DBS's interest income fell 7%, its overall profit still edged higher, carried by record wealth management and fee income. This is the strategic shift to watch. The banks are slowly becoming less like pure interest rate machines, and more like diversified financial supermarkets, earning steady fees alongside their lumpy lending profits. It's a quieter, more durable engine of growth, and it's a real part of why long-term investors stay optimistic. Even under pressure, though, these are highly profitable businesses, and here the three start to separate. The cleanest measure is return on equity, how much profit a bank squeezes from every dollar of shareholder money. And on this, DBS is the clear leader, generating a return on equity around 17%, exceptional for a bank of its size. OCBC follows at about 13%, and UOB trails at roughly 11 to 12%, weighed down by those Hong Kong provisions. 17% versus 11 is a meaningful gap. It's a big part of why DBS has long been regarded as the best run of the three, and, as we'll see, why it also carries the highest price tag. Which brings us to price, because a great bank and a great investment are not the same thing. It depends entirely on what you pay. The simplest gauge here is price to book, how much you pay for each dollar of the bank's underlying assets. And the three diverge sharply. DBS, the quality leader, is the most expensive, priced at nearly 2.5 times its book value, well above its own history. One analyst called it price for perfection. OCBC sits in the middle. And UOB is the cheapest, at just over 1 times book, partly because of those Hong Kong worries. The pattern is classic: you pay up for the best, and you get a discount on the one with a cloud over it. Which is the better deal is, genuinely, the eternal debate. So if you were going to own just one, which should it be? It's the question every Singaporean investor eventually asks. And the honest answer is, it depends what you want, and, as you'll see, it may matter far less than you think. Here they are, side by side. DBS, the most profitable, the most expensive, the highest headline yield, but remember that yield is flattered by a temporary top-up. OCBC, the middle child, steady, reasonably priced, with an insurance arm and a greater China tilt. UOB, the cheapest, the highest underlying value on paper, but carrying the most worry, thanks to its Hong Kong and China property exposure. There is no objectively correct answer in this table. The premium investor pays up for DBS's quality and consistency. The value investor is drawn to UOB's discount, betting the fears are overdone. The balanced investor takes OCBC down the middle. Each is a perfectly defensible choice. But here's the twist that the head-to-head table hides, and it's crucial. These three banks are far more alike than they are different. They operate in the same small market, lend against the same Singapore property, ride the same interest rate cycle, and face the same regional risks. Their share prices tend to rise and fall together, in near lockstep. So the agonizing over which single bank to pick. It matters much less than people think. Choosing between DBS, OCBC, and UOB is like choosing between 3 doors in the same building. The more important question isn't which bank. It's how much of any of them, and that question leads us somewhere uncomfortable. Because for all their strengths, these are not risk-free investments, and any honest analysis has to give the bear case its full due. So let's turn the picture over and look hard at what could go wrong. The first risk is the one we've already met: interest rates. Banks are, at their core, a leveraged bet on the rate cycle. When rates rise, their margins fatten and profits soar, which is exactly what powered the record years. But that cuts both ways. As rates fall, those same margins thin, and earnings stall, just as we saw in 2025. This makes bank stocks inherently cyclical. They are not a smooth, ever-rising line. They breathe in and out with the economy and with central bank policy, forces entirely outside their control, and yours. By them believing the good times simply continue forever, and the rate cycle will eventually, and humblingly, remind you otherwise. The second risk is credit, specifically, Hong Kong and China. When a bank lends, some borrowers don't repay, and right now the worry is commercial property in Greater China, where values have slumped and offices sit empty. This is not theoretical. In 2025, UOB set aside around $600 million to cover potential losses there, and its problem loan ratio in Greater China climbed above 3%. DBS, with less exposure, sailed through far more calmly, which is precisely why their share prices parted ways that year, UOB lagging well behind. It's a reminder that the World Bank hides a portfolio of thousands of loans, and somewhere out there, a slice of them is always going bad. Usually it's manageable. Occasionally, it isn't. The third risk strikes right at the heart of the appeal: those generous dividends may not stay this generous. Remember, all three banks are currently handing back extra capital through special and capital return payouts, DBS with its 15-cent top-up, OCBC with special dividends, UOB with a 50th anniversary bonus. These are wonderful while they last. But they are, by design, temporary. They exist to return surplus capital that has built up, and when those programs end, for DBS, after 2027, the payouts are expected to step back down to ordinary levels. An investor who buys today expecting that Fed headline yield forever may find it quietly shrinking in a couple of years' time. Not a cut in disgrace, just a return to normal. Which brings us, finally, to the most important part of this entire episode. Not a fact about the banks, a fact about us, and how we own them. It is the single biggest mistake Singaporean investors make. And there's a good chance it applies to you. Walk into any conversation about money in Singapore, and you meet someone who has held one of these banks for 20 or 30 years, watched it rise, and now keeps an enormous share of their entire net worth in it. It feels safe, it's a great bank, it's never let them down, why would they sell? But this is the trap. A single stock that grows to become most of your wealth is no longer an investment. It is a bet, a concentrated bet on one company, in one industry, in one tiny country. And we already know these three banks move together, exposed to the same risks. So owning all three isn't diversification. It's the same bet, 3 times over. And now the fact that genuinely surprises people. You might think the obvious fix is to stop picking banks and simply buy the whole Singapore market, the Straits Times Index, through an ETF. Diversified, problem solved, right? Not quite. Because here is the catch, those same 3 banks make up more than half of the entire Straits Times Index. Slightly over 50%. So when you buy the index in Singapore, you are still putting more than half your money straight back into DBS, OCBC and UOB. The local index isn't the escape from the banks that people imagine, it is, to a large degree, a bank's fund wearing a disguise. Real diversification, in Singapore, has to reach beyond our shores. So what's the answer? It is not, and I want to be clear, to rush out and sell a wonderful bank you've owned for decades. These are excellent businesses, and the dividends are real. The answer is about proportion. The wealthy don't avoid great stocks, they simply refuse to let any single one of them become big enough to sink the ship. As a rough principle, when one stock, or one sector, grows past a quarter, a third, half of everything you own, it deserves a hard look, not out of fear, but out of prudence. And the cure, as we saw in episode 1, is to diversify outwards, into global companies, through those Irish domiciled world ETFs, so your future doesn't rest on 3 banks on one small island. Keep the banks. Just don't let the banks be everything. So if, after all of this, you decide these banks do belong in your portfolio, and for many Singaporeans, they reasonably do, how should you actually own them? A few simple principles. First, size the position deliberately. Decide, in advance, what share of your wealth you are comfortable holding in banks, and then stick to it, trimming if a winner grows too large. Second, rather than agonizing over which of the 3 to pick, you can simply own all of them in a single click, through a low-cost Straits Times Index ETF, just remember that's already over half banks, so that is not your diversification, it is your bank position. And third, if you're buying in over time, do it steadily and automatically, the dollar cost averaging we covered last episode, rather than trying to guess the perfect moment near these record highs. Own them as a deliberate, sized, sensible slice of a bigger whole. Never as an accident that simply grew. So let's bring it all together, and answer the question we started with, as plainly and honestly as I can. Here is the balanced verdict. As businesses, Singapore's three banks are about as good as they come, fortress strong, magnificently profitable, among the safest on earth, and paying real, tax-free, rising dividends to their owners. That is not hype, it is fact. But, and it's a serious but, they are also fully priced today, sitting near record highs and above their own historical valuations. They are cyclical, currently leaning into a falling rate headwind. Their fattest dividends are temporary. And they are dangerously, seductively easy to overown. The conclusion writes itself, these can be a wonderful part of a portfolio. They make a terrible entire portfolio. So own them, if you choose to, for the safety, for the rising income, for the quiet pleasure of dividends that land tax-free, year after year. But own them with your eyes wide open. Know that the headline yield may be flattered. Know that they breed with the rate cycle. And above all, know how much of your future is riding on three banks in one small country, and make sure the answer is a number you've actually chosen, not one that simply crept up on you over the years. The banks have rewarded Singaporean investors handsomely for 50 years. They may well do so for 50 more. Just never let them be the only thing you own. I'm glad you spent this time with me. I'll see you in the next one. Thanks for watching. If this made building wealth in Singapore a little clearer, give it a like, and subscribe to Lukebook so you don't miss the next episode. See you in the next one.